Mahesh Patil then joins in on the show. Mahesh, hi, morning. Just looking at the kind of price action that we've seen, and I'm just going to pick up the last 6 days, because, for the sixth consecutive session, we had a green close yesterday. The Nifty is now up 10% in the last nine trading sessions, Mahesh, and this when the index leader, that's Reliance, has gone up only 2%. What is it telling you about the momentum and the mood in the market right now?
I think what we're seeing in the market, while the flow in terms of buying and this thing is not that great, I think the negative news, which was there on the company front or on the economy front, I think that is turning a bit positive. And we are seeing various sectors actually and various stocks, playing out one by one. I mean, be it the IT sector, at some point in time, or some other sector, whether it's the metal space, or even the financials are starting to turn around. So I think as we get into this quarterly season, we are expecting, some of the companies, where the numbers are likely to be better than expectations, we are seeing them getting re-rated. And I think it's just the lack of any negative news and some positive delta in terms of sectors, which is giving the momentum for the market to really scale new highs at this point in time. We are expecting this year, compared to the earlier period, where you would have thought there will be a sharp decline to earnings in FY21. I think now it seems that the decline in earnings in FY21 won't be much. And if you look at our estimates also for this year, it's showing more of a 2-3% decline, which is not much, considering the fact that the GDP decline will be almost 4 to 5%. And I think that is what is probably giving support to the market even at these levels.
Yeah, seems to be the case. Mahesh, banking and insurance continue to be themes of interest for you. It's interesting what's playing out in both these spaces. You had a Bajaj Finance wherein the Q2 update did not sound all that confident. The picture going forward looks still very hazy for them. We saw how the markets as well sort of punished Bajaj Finance on that day when the Q2 update came out. And then within banks, you have the concentration and move of flows, which is completely migrating towards an HDFC Bank solo, which has actually managed to outperform and show leadership as opposed to the rest of the Bank Nifty constituents. Are you rejuggling your positioning when it comes to insurance and banks in any which way?
So, in the banks, you're right. I think a couple of banks are exhibiting really strong growth on the retail side, and that is what is leading to outperformance over there. But I think in the banks, it's clearly going to be the asset quality, because growth is going to be muted, and trying to grow aggressively in this kind of environment, where the overall demand is still fairly weak, won't be the right matrix. It's important to understand that where the asset quality is going to shape up after the moratorium. And wherever we have comfort on that post-moratorium, the overall restructuring book would not be that high. And banks have taken adequate provisions, right, in this last quarter. And FY22, they'll probably start on a clean slate. I think those are the banks, which we are focusing on in the banking sector. And even on the NBFC front, I think the similar stance in terms of companies which are during this period have actually focused on collections, focused on their risk management rather than growth. I think this year, we don't want to really look at banks or NBFCs which are trying to grow fast, but which are doing the cleanup job this year and creating the foundation for growth next year are the banks and the NBFCs which really we are consolidating that at this point in time. And the insurance sector has been steady. We've seen few of the insurance reporting strong numbers, but otherwise, overall APE growth this year is going to be more or less flattish. And we've seen some consolidation now for the insurance names in the last few months. But I think the overall insurance sector also looks fine for us. I mean, you should see growth coming back next year in the mid-teens. And don't see any major challenges over there. So continue to hold on to our insurance names, and within the banking and financial, as I mentioned, be very, very selective.
Sure, fair enough. Mahesh, IT, let's talk about that, because the kind of move that we've seen, the kind of commentary, outlook, it's sounding incredibly positive. And while, of course, some of the IT names have already been on most people's radar, especially the key ones, what are you making of the kind of optimism that's now being built into the entire sector?
IT has actually, the mood has turned positive in terms of the outlook. And the commentary also coming in from the large IT players is suggesting that we are seeing a significant shift in terms of the IT spend. Contrary to the fact that in the earlier downturn when we have seen after the global financial crisis, the IT sector also got impacted because of the slowdown in the economy. We saw cuts in the IT spend, at least discretionary spend. But this time around it is different because of the pandemic, and a lot of companies are now trying to invest on the digital side, right, and going towards cloud migration. That's a big trend which is emerging. And a lot of these spends are not coming in from the traditional IT CIOs, but it's driven by the marketing department and the sales. And that is leading to a significant improvement in terms of the spends towards IT, towards digital and cloud migration. And that in turn has changed the outlook for growth for the large IT names. I mean, earlier we were looking at a growth of somewhere around high single digits. Now that can potentially be in the low teens going forward. And that has related this overall sector. And in this kind of environment where growth visibility is still a challenge across a lot of sectors, we are seeing this sector outperform. And also, I think the margin outlook in this sector has also slightly looking better because many companies are, at least currently because of the cost savings, and also in terms of future, because of more outsourcing, which could happen in the current environment, and Indian companies are best in terms of the outsourcing model. I think you are seeing now margins either stability or margin improvement in a few days. So I think all these things is leading to the outperformance of the sector, and we think that it could be slightly not just a one-year phenomena in terms of growth, but it could probably be much longer and can be a multi-year phenomenon. So I think the sector might remain elevated. What the re-rating, what we are seeing in the last 1 year, that might sustain.
Okay. What about in terms of the kind of data that's suggesting a pickup, whether it be retail, whether it be two-wheelers, just ahead of festive season, even home sales for that matter? We are starting to see indicators all around of a better recovery. Is that leading to a certain strategic, path for you at this point of time?
Yeah, so retail, again, within that retail space, especially home improvement and other consumer durable companies, we are seeing a good amount of improvement. I think the demand there is coming back. And the festive season, as I rightly said, would be the key to really see how the mood turns around in that sector. So overall, consumer durable sector, home improvement sector, we are pretty well positioned over there. And we think that this sector should do well coming out of this crisis. And even for a longer term, I think the penetration levels in these categories also that should continue to drive strong growth in that space. Apart from that, I think in the overall retail sector, we've, consumer discretionary items. Okay, there we're slightly a bit cautious over there, especially high ticket consumer discretionary. I think there the demand recovery will be much more slower. And home, I think retail on the real estate sector, which is not retail, but on the consumption side, I think we've seen that there are initial signs of recovery on the real estate side. Last couple of months, we've seen the commentary from the real estate players that the demand is slowly coming back. And I think we are at an inflection point on the real estate sector where the pricing environment has been now stable for many years. Affordability is slowly inching up. And with interest rates where they are around 7% or so, we could see a pickup in overall real estate market. And companies which are catering to that sector, I think could see improvement in sales going forward. So I think remain constructive even on the real estate sector and other ancillary sectors which are going to benefit because of uptick in that space.
Mahesh, wanted to also get in a question from you or an outlook from you on the latest NFO, the ABSL Special Fund. Can you fill us in with the details?
So this is kind of a special situation fund, but it is not limited to special situations, okay, which can be short-term events leading to either some company-specific action or merger and acquisition or any kind of a event which can unlock value into a company. But we are also looking at structural opportunities, okay, which are coming up. And this current pandemic is throwing up a lot of opportunities in various sectors, which we think would sustain over a longer period of time. I mean, be it what the government is trying to do in terms of the Atmanirbhar Bharat, focusing on domestic manufacturing, the production PLI scheme, which has been launched, that throws up opportunity for a lot of sectors, companies in the manufacturing space. We've seen what is happening because of trade war between US and China. And many companies are now globally are looking at outsourcing from India and shifting their production base. So that's throwing an opportunity for companies, say, in the chemical sector, specialty chemicals, or in the textile space. That's again an opportunity, okay, which is a special opportunity which is emerging at this point in time. Also looking at the government finances, okay, as they are, and they have fiscal deficit. There is no doubt that government needs to go out and do privatization because they will unlock value and raise money. So that could potentially play out a theme going forward. So this fund is likely to, it's actually a multi-cap fund because we find special situations and this opportunity across sectors. And as and when, and at this time, actually, there are a lot of things which are happening around which gives a lot of opportunities to build a portfolio. And we think that the timing is right for investors to look at it. And again, the overall construct in this fund will be to look at companies not only through the special opportunities filter, but also through our filter of buying good companies with good cash flows and steady earnings from a long-term perspective. So that's, in a way, I think, where we think the allocation for this fund can be not only from thematic side, but also from the multi-cap allocation can be allocated to this Birla Sun Life Special Opportunities Fund.
Okay, those are the details on the new fund offer. And when it comes to earnings, Mahesh, what do you think is going to be very critical this quarter? Because there is the festive season. You know, you have a lot of companies that have now got their strategies in place to combat the pandemic as well. And, you know, we are seeing capacities returning to normalization, demand as well picking up. Is that going to be reflected in this quarter, or with the gradual economic recovery, you think that we'll see that, say, Q3, Q4 onwards?
So I think clearly this quarter, Q2 numbers will see some kind of an uptick, but it will be varied across sectors. But I think what we're seeing is that, and that's what is leading to actually the earnings downtick as much as we had anticipated earlier, is that there's a margin improvement, or at least margins are better than what one would have expected, okay, when we see such a sharp volume decline. And companies have been, corporates have been able to cut down on costs on various aspects. And that is helping companies to at least show a better EBITDA growth. So I think this quarter, I think, would be initial signs of recovery panning out. But really, I think third quarter will be key to see that how the demand sustains. Because in many companies, we could see that inventory filling is happening, because first quarter was a total wash-off, okay, where the inventories were brought down. And in the second quarter, we are seeing some primary demand which is there, but also inventory fill-up, which is helping some of the companies. And I think the next quarter, third quarter, will be a real indication in terms of how the underlying demand is and shaping up, which will give a clear guidance in terms of how we are coming out of this crisis and how the growth outlook is going to shape up in the coming quarters.
Mahesh, what is your outlook when it comes to the pharma sector? Do you think that it'll largely emerge stronger on the back of strong exports? And where within pharma are you seeing opportunity? Because day after day, you know, we are seeing a lot of value within the pharma space, and it's not just been over the past few weeks. This trend has been long sustaining.
Yeah, so the pharma sector has done exceptionally well in the last 1 year. It's given a huge outperformance. And again, I mean, the valuations there are now looking fairly comfortable. There's not much upside in terms of multiples. But I think in the pharma sector, domestic pharma has been growing steadily. And because of the COVID, there are specific opportunities. A few companies are benefiting, which are catering to the COVID demand and seeing a strong growth. But it's been on the export front, really, US generic space, which was a big pressure point and pain point for many years. That's seeing a big up move. And Indian companies are well poised to really capture and cater to the demand coming in from the global front. Especially in the API segment, we have seen that Indian companies have been able to displace some of the Chinese companies and cater to their incremental demand. While that's a short-term opportunity and will probably wane in the next couple of quarters. But I think a lot of companies which have invested in R&D in the last 5 to 8 years, I think they are seeing some of these products coming to the market. And with the competitive environment slightly easing off, they are seeing a better margin and environment for these products. So overall, US side, I think growth, which was kind of declining, should actually be in somewhere around 8 to 10% for the pharma companies. And domestic growth should be fairly steady. But now I think the pharma would be more stock specific. I think the overall re-rating in the sector, what we've seen underperformance there, that's been taken care of. And it will be more stock specific from here on, because the broader valuation re-rating, I think, is behind us. And we still like the sector, I think, going forward. There are still structural drivers in place, but we'll be more selective in the overall pharma sector.
All right, fair enough. Mahesh, we're coming down to US elections as well now. So just to get a bit of a world view from you as well, in terms of what you're anticipating, in terms of, volatility, things seem to be intact, with the hopes of a stimulus when it comes to Wall Street, but anything untoward that you're factoring in?
The election, one is the election outcome and how the markets will react to that. Right? We have seen that last time around. So I don't think we should be too much bothered about it. But clearly, I think we should see increased level of volatility now, looking at where the markets are, the global market as well as our markets. And in that scenario, I think one would tend to be a bit cautious because the volatility is going to increase. But I think clearly the policy environment in the US, I think from the central banks, and that's not going to change. I think they'll continue with the same policy of easy monetary policy, good liquidity, low interest rates. Yeah, there's some fear that whether you could see increase in the tax rates for the corporates, and that could impact some of the companies and the markets in the US, depending on whether the Democrats come to power or not. But by and large, I think barring volatility, I don't think that should change the longer-term trajectory for the markets and for the economy.
Mahesh, the latest reports when it comes to the cement industry seem to indicate that it has been very resilient. You are seeing the price hikes as well that are managing to help cushion the cost pressures. Lots of interest as well within the cement names, not just in the large caps, but the mid cap counters as well. Are you sensing opportunity here?
The cement has done actually fairly well despite the slowdown in the economy. Right? Normally, would affect. Seen this sector getting impacted. So it's mainly because of pricing stability and also to some extent cost benefit. So we've seen the margins, EBITDA per ton has really held on, but volume growth was missing. So now I think in this month we are seeing that the volume is slowly starting to come back. Okay, and I think if the real estate sector picks up, while the rural demand has been fairly strong, but if the real estate sector picks up going down the line, I think you should see the volume growth also coming back to around 4 to 5% next year. And the sector is seen a good amount of consolidation. Profitability is slowly likely to improve. So it could be a good proxy to play the overall investments in the infrastructure. And yeah, I think we are constructive on the cement names, both large cap as well as the mid cap space.
It seems like for a lot of the EPC product firms as well as capital goods that now capacities are pretty much back to normal. There has been a focus on improvement of liquidity. The labor shortage as well seems to be normalizing. Are you penciling in a recovery in this quarter within the capital goods stroke even construction space?
So I think the capex story is still slightly long away. I think it will take time for the overall capex to pick up in a meaningful way. Still, the capacity utilization levels in the sectors are still lower than the normal levels. And I think the big capex push, see, from the government side, we are not seeing large investment because, as I said, the government is still struggling because of the fiscal deficit. They don't have too many levers to kickstart big infrastructure investments. So I think the recovery there will be slow and gradual. Even the government scheme for getting manufacturing, domestic manufacturing and the production link intensive, a lot of the sectors, okay, where they're looking at investment is not going to be very large capital intensive. And to that extent, the capital goods sector, I think, will still take some more time. It will probably be a late cyclical and we would probably wait for really to get into that sector at this point in time. And overall construction space is fine. I think the order inflow has been okay-ish, not as strong as one would have expected, but the valuations there are very attractive. So longer term view, I think in that sector, as we see demand slowly coming back, as government is looking at various avenues to monetize some of the existing assets, and that will be used to really fund some of the new projects in the road sector. I think that could lead to an improvement over there. So margin neutral, okay, not so excited on the capital goods sector.
Mahesh, it's been a pleasure having you on board. Many thanks for discussing your outlook on the market, sectors with opportunity, as well as the outlook on the RBI policy.